Hello, I'm Brad Eichler, Head of Investment Banking for Stephens, and thank you for being with us today. We had an active year during 2021 advising our clients on a wide range of assignments, and 2022 is already shaping up to be just as energetic for us. Last year, our investment banking group closed close to 200 transactions globally with a total transaction value of almost $33 billion. Over half those transactions were mergers and acquisitions, and 15 were cross-border transactions involving both our U.S. and European bankers. Obviously, there's a lot going on in 2022, and we've been tracking the major themes closely. These include, obviously, COVID, supply chain disruptions, the U.S. infrastructure package, inflation, and the prospect for higher interest rates. Now let's hear from our product heads and other key senior bankers as they discuss how these trends and others are impacting their service areas. With us today are Scott Studwell, Head of Equity Capital Markets, Davidson Hall, Head of Debt Capital Markets, Sachin Lulla, Head of our Capital Solutions Group, Shaun Holmes, who is Head of our Capital Solutions Group and Debt Capital Markets in London, as well as being the head of our London office, Marshall McKissack, who is Head of our M&A Advisory Practice, McFarlin, who runs our family advisory practice, and then Brian Bratcher and Simon Tilley. Brian is the head of our sponsors group in the US, and Simon is the head of our international sponsors operation. I'd like to start by addressing a question to Scott Studwell, again, who's the head of our equity capital markets group, as well as our depository practice. Scott, we had a near record 2021. Maybe you could start by talking a little bit about what were the global trends we saw in the market during 2021 and how things are shaping up for 2022?
You bet, Brad. I guess what I'd say to start is going to be very difficult to replicate the activity that we saw in the equity capital markets in 2021. By every measure, it was an outstanding year for issuance here in the U.S. But I think it comes down to one key thing in 2022, which is the Fed. I think the interest rate environment is going to really dictate the pace of activity that we see throughout 2022. And the $64,000 question in my mind, and I think in everyone else's mind on the street, is just, how far and how fast will the Fed move? So I think we've gotten a glimpse of what investors think. If you look at what the markets have done since the mid part of November, when clarity around rates, I think, really began to crystallize. We've seen major pullbacks in the NASDAQ and the Russell 2000. And the NASDAQ obviously is a growth-related index that's in correction territory, off about 10+% year to date, with the Russell being off over 15%, since mid part of November. So that's the backdrop coming into the year. Now, 2021 was the fourth consecutive year of increased issuance in the U.S. IPO market. And I just do not expect that to be the case here in 2022. Really the main driver of that, I'd say two main drivers. One is the interest rate environment, which we've just talked about, and how that's really leading to a rotation from growth into value that's been, I think, pretty evident early here in 22. And then second are the return profile of the IPOs that we saw in 21. Nearly 2/3 of the deals have traded below market. So, that weighs on the psyche. So, all that said, we had a very active year in IPOs last year. And, I think we're going to have an active year, but just not at the same pace. The reality is we have over 100 companies in registration right now in the U.S. IPO backlog. And there's still a significant, pent up demand for venture-backed or sponsor-backed companies to use the IPO market as an exit strategy of some sort. One thing to point out is sponsor-backed deals outperformed the general IPO market in 21, and I think that bodes well for the setup going into 2022. Related to the follow-on market here in the U.S., last year, again, another very active year. Over 800 companies that were listed in the U.S. came to market, raising over $225 billion. I think the pullback that we've seen with this pullback in some of the growth areas of the market, tech and healthcare in particular, will certainly affect the pace of activity in 22. We've seen a correction in values, and as a result, I think there's just going to be less interest from those issuers to tap the markets, but still expect an active marketplace. I also think you're going to have maybe a little bit of an offset here because there's some still concern that interest rates will maybe dampen the profitability profile of companies. And I think sponsor-backed companies are going to try to stay out in front of that trend. And again, I think coming off of a strong 21 on a relative basis, they're probably better positioned to tap the markets in 22. Last year, we saw a significant explosion in SPAC activity. An explosion that I don't think anyone believes can be replicated. But if you factor in the number of SPACs that are still looking to de-SPAC, there's close to 600 companies that have yet to de-SPAC. And so I think SPAC issuance will still be a big player in the U.S. capital markets, but clearly we're going to need to see some of these de-SPACings happen. And I think there's just going to be a higher bar on where investors, put their cash in the short term, given the interest rate environment. Investors, hedge fund investors who previously didn't have a lot of places to go park their money are, beginning to have more options. So I think when you put it all together, very difficult to repeat the activity we saw in 21. But I do believe the U.S. capital markets are still wide open. And in fact, I think what we are beginning to see is maybe a rotation where companies that have been in sectors that have been out of favor the last few years, I would name energy and financials as two that outperformed in 21, have been outperforming since the interest rate environment has gotten some clarity. And both sectors are at a point now where valuations have improved. And I believe companies in both sectors have a pent-up interest to grow. And so I think we're probably going to see a little bit of a market rotation. But all in all, capital markets conditions are still pretty good here in the U.S.
Scott, what are the main drivers of the IPO market strong performance in 2021? And as a class, how did those IPOs perform?
So, I think the performance of the IPO market is, somewhat bifurcated. The deals in the first half of the year versus those that came in the second half of the year. The end result, though, were 2/3 of the U.S. IPOs that came to market last year traded below issue price by year end. And so I do believe that, does present challenges to investors, which give them a bit more leverage around pricing. But there's still going to be significant interest in the IPO market simply because this is theoretically the area of the market where you can buy companies at a discount to their intrinsic value. And the IPO market for many investors is a basket approach. You're going to have some that don't perform the way you want them to, and you're going to hit some home runs. And so I don't believe investors are going to pull back from the market by any means, but I do believe that perhaps more selectivity and a little more leverage around pricing is probably the best tool in their toolkit to combat some of the issues we saw last year.
Thanks, Scott. Now let's turn to the debt capital markets with Davidson Hall. Davidson, there's obviously a lot going on in the debt capital markets right now, namely inflation and rising interest rates. Could you talk a little bit about what we've seen in 2021 and your expectations for 2022?
Sure. Brad, the past 2 years, as Scott alluded to, have just been unprecedented across the capital markets. And, it's hard to believe that we would outperform 2020 from a leveraged finance perspective. And then we encountered 2021. We had $465 billion of issuances in 2021, which was up over 2020. And, the predictions for all intents and purposes for this year is for that number to be slightly down to around 400 to 430 billion across the high yield market. I think, from an inflation perspective, it's here, right? CPI is up almost 7%. M2 is at 21 trillion, which is 6 trillion above where it was 2 years ago. And by order of magnitude, it took the Fed, I guess, probably 10 years to put another $6 trillion into the market prior to that. So in 2 years, we've done what we did in 10 years. And from a high yield perspective, we're going to be watching it significantly. There will be a bit of a push and a pull going on between what the issuers want and what the investors are willing to give. Obviously, issuers are going to want to go as long out on the curve as they possibly can. And I think the investors aren't going to want to do that for obvious reasons. And I think after March, we'll probably see a little stability in the high yield market, but between now and March, I expect some pockets of volatility. We haven't really seen volatility since probably April or May of 2020. It's been pretty stable with rates and spreads compressing on the whole. I think, basically a 25 basis point increase is already baked into the market. We've seen 1-year LIBOR up about 30 basis points in a month, which is almost double. So I can safely say we're 25 basis points is probably baked into the market. I personally would like to see a 50 basis point increase in March. I think we'll see at least 3 hikes this year. And that's going to create the volatility that I'm talking about. So what does that do for the bond market? I think you're going to see, from an M&A perspective, wider flex language, no question about it. And that could slow down a few of the M&A processes as sponsors get more entrenched in negotiating against their balance sheet banks and trying to get better flex language. Clearly, in pockets of volatility, the balance sheet banks from an underwriting perspective are going to want to have wider flex language to protect them. So I think we're going to keep an eye on that.
Davidson, how did the middle market perform, and how does that compare with larger firms that were in need of financing?
As you drift into the private credit markets, I think a couple of things are interesting. I think it's going to be the tale of two cities, so to speak, in that the really solid credits are going to see outsized pricing. The average unitranche yield today is right around 6.4%, and that's down from about 7.3%, 7.2% at the beginning of last year. And I think if it's a unitranche of size, so 250, 300 million and above, I think you will probably see that magic number of L500 get broken, and you'll see pricing with a 4 handle on it, which we just typically don't see. On the other end of the spectrum, I think if you're in the lower middle market or middle market, the pricing will remain relatively flat for the good credits. So you're looking at a yield of around 6.4, which is kind of LIBOR plus 550 area. I wouldn't expect us to break through that, but for a few certain really specific instances where you can really underwrite to sustainable EBITDA. The company is able to show that they don't have supply chain issues, and they're also able to pass through the costs that we're certainly seeing as a result of rising energy prices, rising labor prices, inability to find labor, et cetera. So I think from that perspective, it will be the tale of two cities, but I don't really expect yields in the private credit market to expand all that much. We saw roughly $70 billion of capital, best we can tell, in the private credit markets raised last year. Now, to date, we've got over 500 funds seeking north of $300 billion in capital. To put it in perspective, it's usually kind of about 300 seeking about 150 billion of capital. So with the resilience that these credit funds have shown in 2020 and the lack of default rates, the private credit vehicles become much more popular for LPs. And therefore, I think you'll have a bit of a supply and demand imbalance, which will keep the amount of capital raised, will keep the yields lower on the whole for the issuers. But we expect this to be another very, very active year. I think in the second half of the year, we're really going to want to pay attention to some of these middle market and lower middle market companies that maybe don't have pricing power and aren't able to pass through the rising costs associated with energy, labor, and everything else I just spoke of. And we could see the default rate start to tick up at the end of the year. So my advice to companies today is certainly to get out in the first half of the year right now while the market is incredibly frothy and folks are generally optimistic.
Davidson, thank you very much for your comments. I'd like to turn next to Sachin Lulla, who, as I mentioned, heads our Capital Solutions Group. The Capital Solutions team is something we've had in the UK for a number of years through Shaun Holmes, who we'll get to in a minute, but is a relatively new addition for us in the US. Capital Solutions, the easiest way to think about it is butts up against our debt capital markets team and really helps in more challenging balance sheet strategies and balance sheet solutions type situations. And so we're really excited to have Sachin on the team. Sachin, maybe you could take a few minutes and talk about what's happened in the market during 2021 and your expectations for 2022.
Sure. So traditional restructurings generally come in cycles, and the 2020 to 21 cycle was fast, intense. It was focused on energy and retail, and then companies directly affected by COVID. So thinking of travel, entertainment, hospitality. The cycle was short because fiscal and monetary policy was intense, preventing a deeper credit crunch. And on top of that, creditors were generally speaking enormously flexible and provided a substantial amount of accommodation, which normally doesn't happen. Now, that accommodation will likely come out of the market gradually over time. Given the amount of capital available and the continued economic tailwinds, I don't see any expectations for a credit crunch or a recession or restructuring cycle anytime soon. And as Davidson mentioned, default rates are approaching all-time lows, both in number and the default rate itself. And that likely continues for the majority of this year.
Sachin, what are some potential problem areas where potential restructuring candidates should focus attention?
As Davidson alluded to, as the Fed starts to tighten, takes liquidity out of the marketplace, and companies that can't pass on price increases and inflation that they're seeing will likely have some. They'll struggle a little bit as the year goes on. So. And there'll also be some companies that haven't fixed their problems just coming out of COVID. So, we expect from a traditional restructuring perspective, the year to be fairly slow with default rates picking up towards year end for companies that haven't fixed problems. That being said, the market is pretty accommodative right now. So if you do have any stress in your capital structure, now's the time to try to figure that out. And where I expect most restructuring professionals to spend their time this year is really on liability management. And what I mean by that is whether it's credit agreement amendments, maturity extensions, exchange offers, or complex refinancings to buy time, extend duration of the capital structure, potentially capture discount, and just have enough flexibility and liquidity to continue to operate. Industries of focus there will be kind of the companies that still have a stressed balance sheet because of COVID. So it'll still be travel, entertainment, hospitality for the most part, a couple energy companies that haven't fixed their balance sheet. And then as time goes on, it'll likely be companies that haven't fixed their problem with their lender and the accommodation comes out of the market. So, as lenders want to exit credits that they view as stressed. And then as time goes on, the question will be, what does inflation do in supply chain disruptions? If you can pass through pricing, you'll likely find a way to keep going and avoid restructurings. But if you're unable to do that, then it's very possible that you will be a candidate for restructuring as towards the end of the year. So it's important to focus on fixing your problems as soon as possible when markets are accommodative. One other area where I see an opportunity for restructuring professionals to spend time is actually a sector that doesn't really have a lot of debt, but it's high growth companies that are burning substantial amount of cash. Many of them recently came public through IPOs and SPACs. And with the correction in growth stocks right now, many of them will lose access to equity capital markets, or it's possible a traditional equity deal will be highly dilutive, where a structured debt or equity transaction may be a better option. So what I mean by structured debt and equity is really a security or a loan that has debt-like properties, but equity-like upside, similar to convertible notes, but unlike convertible notes, they are highly customizable and negotiable terms where convertible notes are generally market driven. Our team has a lot of experience with both restructurings, liability managements, and structured capital raises, and we're looking forward to an active year.
Great commentary, Sachin. In keeping with debt capital markets and capital solutions, maybe we can turn our attention next to Shaun Holmes in London. Shaun, what are we seeing in the London market around these two areas, and what are your expectations for 2022?
Sure, thanks, Brad. Last year we saw very strong debt markets supporting a very strong M&A market. Dry powder was significant, competition was strong, opportunity for refinancings, opportunity for supporting M&A. We saw great demand. And the net result of that over the year was improving leverage opportunities, reduced pricing, and in terms of documentation, the covenants that were being inserted were pretty light and giving issuers very good headroom. So very sort of credit friendly or issuer friendly in terms of issuance. In terms of restructuring, very quiet. It was a very quiet year on the back of the pandemic. There was significant government support. There was significant forbearance being provided by the credit markets, and therefore we didn't really sort of see a great deal of stress for the majority of last year. However, coming into the back end of the year, there was increasing challenges in terms of supply chain, increasing challenges in terms of inflation. And a big feature that we saw towards the end of the year was wage price and energy price inflation. Overall, it didn't necessarily sort of dampen demand for credit. And so as we come into 22, M&A volumes we expect to continue to remain strong. And therefore, there's no indication at this stage that the debt markets will be anything other than supportive. As we sort of think about the outlook, direct lending is, I think, going to continue to sort of dominate in the European mid-market arena, with banks more likely to be supporting in terms of the revolvers rather than necessarily issuing the term facilities. And the other thing that we've seen more over the last few months is ESG-linked lending, where ratchets are being offered by the credit funds in terms of any sort of ESG benefits that can come through.
Shaun, it sounds like ESG-friendly businesses are at a clear advantage. Is there a corresponding disadvantage or negative impact for companies without positive ESG credentials?
It's not necessarily that there is a negative impact there. It's more that there is an incentive for the issuer in respect of its ESG credentials, and through audits each year, it will give the issuer a small benefit in terms of spread over those where they're not necessarily ESG incentivized. I think the thing that will be interesting to monitor in terms of the maturities market, so as issuers sort of come to maturity, is where they may not necessarily follow those ESG credentials. The challenge for them in terms of refinancing may be greater. And there is increasing discussion amongst some of the banks and some of the funds that there are certain credits that will not necessarily be able to be supported when they come up to maturity. So I think that will be an interesting feature that we have to consider as we work through the next few months. In terms of the restructuring market more generally, we are seeing the stimulus programs ease off, and we have got those inflationary pressures that I mentioned coming through. So I would consider over the remainder, the sort of during 22, we will see increasing challenges coming into the market and a need for restructuring support to be provided.
All right, Shaun, thank you very much for your insightful comments. Maybe next we can turn to Marshall McKissack, again, who runs our mergers and acquisitions group. obviously a tremendous amount of mergers and acquisition activity during 2021, setting the stage for a strong 2022. Marshall, could you talk to us a little bit about your thoughts on both, please?
Yeah, Brad, thanks. 2021 was a record year for, M&A globally, north of $5 trillion of acquisition value. It was, a record year for Stephens as well. And it was really across the board. It's, big cap, middle market, lower middle market. We really saw a significant increase in volume this year. A lot of it's driven by tremendous amount of capital available, a lot of cash, a lot of dry powder with private equity and historically low interest rates. That's been a recurring theme for the last few years. 21 also benefited from a dearth of deals in 2020 from COVID and, some carryover transactions there. And then there was a significant push, in 21 to try to beat a potential tax increase in the U.S. A lot of deals driven by, people wanting to get transaction across the board and get those transactions in before potential tax increase. Again, it was a significant year for us. Very active. The fourth quarter of 21, I think you could say that the deal market was oversaturated. Literally, too many deals trying to get done. Capital there. But the ability to physically process those transactions with bankers, lenders, accountants, deal attorneys, the market really started to back up. So as we enter 22, a tremendous amount of activity that's carried over from 21, a lot of processes that would have normally launched in the fourth quarter, will launch, in these first few weeks of January. So we're anticipating a busy 22 as we carry over those themes. I think there's a lot of things that people and buyers in particular are focused on, and sellers as well, as it relates to some of the topics that have been mentioned: supply chain disruption, inflation, labor. All of those potential issues are impacting really where buyers and sellers see the normalized earnings power of a business, and trying to understand where that is, just given the tremendous amount of fluctuation. So that'll continue to be a theme. What's real growth, what's inflationary, where is pricing. So we'll continue to watch those in 22.
Marshall, what are some specific concerns for public companies that are contemplating transatlantic transactions?
From a public company perspective, they continue to be very, active acquirers of business. I would say that they're extremely focused, very, tailored, looking for solutions that add to their growth and supplement organic growth, which has been somewhat anemic over the last 3 or 4 years. Looking to really, position themselves to, utilize currency, cost of capital advantage, synergies to win processes, but super focused on things that fit with a core. In the same vein, I think we'll continue to see public companies rationalize businesses that are non-core. So an increase in divestitures that will continue. Focused on the core, lower cost, low return businesses that don't fit. Exit those and focus their capital and core competencies. Private companies continue to need scale. They're looking for growth opportunities as well, shore up areas of deficiency, and add and look for synergy opportunities as well. I think we continue to see a tremendous amount of generational shift in ownership. The next generation looking for somebody to continue to share sponsorship of the business as they look to grow. Those themes will continue in 22. And then, as you mentioned, Brad, transatlantically, the opportunities continue. A great year for Stephens. in those markets as we've helped buyers and sellers access, different continents, different opportunities. I expect that, those activity levels will continue to increase in 22 as buyers and sellers look for different partners, look for different opportunities to grow the business, synergy opportunities. Those things will continue, and then hopefully, if we can get on the down slope of COVID, an ease in travel restrictions, would certainly help, partnership opportunities, diligence efforts, and would just help continue to to buoy that market. But all in all, we're looking forward to a continued busy year for sure in the first half of 22. But expectations remain high.
Thanks, Marshall. In keeping with things that we think make us unique, maybe we can turn our attention next to our family advisory business, which is run by Mickey McFarlin. In family advisory, we call on family offices as well as family held businesses. And being family held at Stephens since 1933, we don't think that there's anybody in America that's got a better understanding of family held businesses or a better message to family held businesses than our firm. So we're really excited about that.
Yeah, thanks, Brad. As you noted, we think about family enterprises. We paint them with sort of two broad strokes generally. There's family businesses where the family's still involved in operating the business and growing that asset. And then there are family offices where oftentimes the family has exited the legacy business and now has a pool of capital to deploy, manage, and protect. And really, those are two different sorts of entities, but they're interrelated in our world, and we expect to see a lot of opportunity for partnership among the groups. Starting with family businesses, the things that are on their minds today are many of which were noted by Marshall in the M&A markets: inflation, staffing issues, supply chain disruptions, et cetera. And how do you deal with all of these issues and manage your business day to day? I would tell you that as a group, broadly speaking, our family business clients are focused on growth. They're very even with some of the storm clouds out there with inflation and potentially higher interest rates. They're excited about the growth of their business and the opportunities in front of them. They're deploying capital, oftentimes in the face of the supply chain issues, onshoring, production in some cases, versus outsourcing that to China or other areas. And so there's a developing need for capital to support that growth through acquisition, through new capital deployment, et cetera. And a lot of these families have most of their net worth tied up in these businesses. And so they're out there looking for a partner to really support that growth, help them with capabilities in M&A or other ways to kind of grow their business. And that's where the family offices really come in our minds, and can be attractive partners to these family businesses. We have a pretty, I would say, meaningful pipeline of transactions where we're advising family businesses today to do just that, to go out and find a capital partner, oftentimes to be a minority or structured equity partner to support, growth, perhaps some, recap some dividends out to the family and take some liquidity, and then keep going on that growth trajectory. And on the family office side, that suits really what they're looking for quite well. The M&A markets are heated and competitive. Family offices are competing with private equity and strategic acquirers day to day. Valuations are elevated. And so you really have to have an angle or a point of view to be successful and deploy capital in this market. And family offices, the most successful ones that we spend time with, are really leaning on what makes them special, whether it's the ability to be flexible in the capital structure, to bring some capability from the legacy business or the way they think about their portfolio that's attractive to the potential partner, to bring cultural fit, to bring legacy and transition. And so we see a lot of opportunity this year to really partner up the family businesses, the groups that need capital, with the family offices, the groups that have capital and are sophisticated in the way that they're deploying it and bringing partnership to the table.
Mickey, family offices are obviously playing an increased role in transactions. Talk to us a little bit about what you're seeing in that market and what your outlook is.
Yeah, that's a great question. We think about the uniqueness of family offices being a couple really interesting attributes. Number one, they're not bound by the typical fund constraints of traditional private equity. And so they've got the sophistication, the ability to move at the speed of business and to be a great long-term partner without the need to go out and, exit a business within 5 years, sell the winners, if you will. And so if, in the instance where somebody's looking for a capital partner with perhaps a longer term approach to help unlock a longer term value opportunity, that can be really attractive. Secondly, they also can be quite flexible in how they play in an investment. They can be, they can take control of the business by 80+% and be the majority partner along with the management team or another partner. They can also be a minority player and be in the capital structure as a common equity sort of, pari passu partner, or they can take a structured position which may look more like debt, where they've got some downside protection, but it leaves more upside for the partner that's looking for the capital and can also bridge some valuation, perhaps some valuation differences of opinion. So we really like the flexibility. And then the last and probably candidly the most important is just culturally, they often are really easy to deal with in terms of, aligning in vision and somebody that you can, see yourselves being partners with for the long term.
Thanks very much. One of the largest drivers of the markets these days is the financial sponsor community. And as I mentioned earlier, we've got two members of the team on: Brian Bratcher, who runs the financial sponsors group and is located in the U.S., and then Simon Tilley, who is Brian's counterpart in Europe. Brian, maybe we could start with you. What are some of the trends that you saw during 2021, and what are expectations for the sponsor community in 2022?
Yeah, Brad. The U.S. PE market saw a record year, which was no surprise. It was up over 2019, which was a record year at that time. Hitting a little over 1 trillion, I believe is the number in deal value, and that was comprised of a little over 8,500 deals getting done in the U.S. PE market in 2021, which is up over 50% over the prior record. So really big numbers as we expected. As we moved through the year, you could tell that the finish to the year was going to be at a blistering pace and hitting record levels. If you break down the PE business and the market, you've got basically capital deployment and you've got exit activity. The capital deployment was at a record pace. What was interesting with the capital deployment is over 70% of that capital that sponsors deployed in the U.S. went to add-on acquisitions for their portfolio companies. It's not something that we were really paying attention to early in 2021. But as the year progressed, you started to see some of those numbers. However, we did not expect it to hit that type of percentage, being almost 72% of sponsor activity. Usually it's more of a blended percentage with add-on activity and platform investment. So we thought that was pretty interesting. We believe the driver behind that is sponsors spent more time with their portfolio companies, looking for ways to grow, to buy and build those businesses at a, and that capital deployment is done at a little bit of a less risky way than buying a new platform. So that was a pretty interesting phenomenon in 2021. Looking at the U.S. Buyout market. When you look at the exit activity, the sort of second component, or the second half of the component for private equity, it was extremely robust. We saw that activity spread across M&A sell side. You heard Scott talk about the IPO market for sponsor-backed companies, the SPAC market. We saw the rise of continuation funds, which is something that has, in the past couple of years, has sort of gone on behind the scenes, but it really rose to the top in a way it has not before.
Brian, can you explain continuation funds and how they operate and what they're seeking to accomplish, please?
That is a interesting vehicle that allows for sponsors to pull a high-performing asset out of a portfolio, deploy new capital with new investors in that company, and continue to let that winning asset ride for a number of more years. So, the two components, again, capital deployment and exit activity at all-time highs. We definitely saw that in our numbers in our sponsor business. The sort of last component for private equity in the U.S. and really worldwide was the fundraising environment. While it didn't hit all-time records, it got really close. The mega funds continue to raise capital and raise funds at a record pace, and those funds are bigger than their previous largest fund. I think, or I believe you can, that's the same for the funds that are really $1 billion to $5 billion and up. We're seeing that in the market where that fundraising activity is, again, extremely robust. They're in the market for a short period of time, and they're getting those funds raised very quickly. So sponsors get paid to deploy capital. And we think going into this year, into 2022, although it will be hard to replicate 2021, we do believe 2022 will be another good year for sponsor business and our sponsor business.
Thanks, Brian, for the very insightful comments. Maybe we can turn to Simon Tilley to close out our session today to talk a little bit about the trends we're seeing in the European private equity markets. Simon?
Happy to do that, Brad. Thanks for the opportunity. In line with Brian's commentary, really, in terms of capital deployment here in Europe, 2021, it felt like a record year as we were going through it, and looking at the stats, it really was a record year. There was a strong recovery in confidence and activity after a pretty subdued 2020. And a number of the themes that we saw in 2021 will carry us through the year ahead. In Europe, a bit north of 7,000 new deals in 2021, and that's up on the normal sort of level of 4,000 to 5,000 that we saw in each of 2020 and 2019. And look, deal value in 2021, it rocketed up to north of 750 billion euros. And actually the powerhouse driving that was the middle market, where deals were up over 60% on the prior year. 21, it was a seller's market, with buyers competing very aggressively for assets in what were often very well attended auction processes, and pricing remained strong. The median EV to EBITDA multiple came in at around 12.5 times. One notable feature that we've seen here in Europe, in common with Brian's commentary, has been add-on M&A for portfolio companies. Like in the US, it was at record levels here in Europe, accounting for around 65% of total deal volumes. The pandemic's led to assets staying in portfolios for longer, and that it really presents an opportunity for well-capitalized private equity-backed players to pursue buy and build strategies to grow products, and service propositions, as well as their geographic reach. From a sector perspective, technology, particularly software, was important alongside healthcare and financial services. And we see that carrying into 2022. Regionally within Europe, the Nordics, Southern Europe, and the UK and Ireland all hit new highs in 2021 in terms of both the volume of deals and the value of deals. And in fact, UK and Ireland was the standout region with over 1,600 deals signed worth an aggregate 200 billion euros. From a fundraising perspective, 90 billion euros of fresh equity was raised last year, which sees European private equity firms having around 270 billion euros of dry powder to deploy. Combine that with strong liquidity in the debt markets, and the deal-making environment in 2022 for financial sponsors is likely to remain robust. Looking at exits, the market in 21 was strong, with over 1,500 exits valued at north of 445 billion euros, and the median deal size in 21 jumped to north of 150 million euros. Interestingly, in 2021, exits were pretty evenly spread between buyouts, trade sales, and IPOs. And in line with Scott's commentary, the IPO market in Europe was strong, with 118 IPOs worth over 100 billion euros. Key sectors for IPO activity included technology, business services, and consumer. However, absent knockout offers, private equity firms are holding assets for longer. And as in the US, we now see the widespread use of continuation funds, which allow the crystallization of value and a resetting of the clock, and for the incumbent private equity owner to hold the asset for longer. We see that continuing through 2022. From a sponsor to sponsor perspective, further growth in appetite for transatlantic deal making has been evident, and that's US sponsor activity in Europe and vice versa, where we're seeing larger mid-cap sponsors in particular using M&A to build domestic champions into international platforms of scale. Transatlantic activity is at the core of driving these strategies. Another marked trend of the last 18 months or so is selling sponsors reinvesting for a minority stake in the business that they have just moved on.
Simon, what is the logic for private equity firms investing in companies that they've recently exited?
Why? Well, they have the opportunity to invest in a known quantity, a business that's already performed well for them. It actually supports buyers getting comfortable with what in the current market are quite eye-watering valuations, and it actually helps with their own capital deployment. So wrapping up, for financial sponsors here in Europe, we did see robust levels of activity in 2021, carrying momentum into the current year, with the mid-market fueling the engine for transatlantic private equity activity. There are undoubtedly some headwinds, as referenced by my colleagues, in terms of supply chain disruption, the ongoing effects and the after effects of the pandemic, markedly rising inflation, and the prospect of a series of interest rate rises, as described by my DCM colleagues. But look, bottom line, there's a huge amount of dry powder needing to be deployed as we emerge from the pandemic, alongside highly liquid credit markets. And that's likely to mean another strong year for financial sponsors in 2022.
Thanks, Simon. It's always great to end on a high note. I want to thank our team for their insights today, and I want to thank you for joining us. Hopefully you found those insights informative. We have a simple focus at Stephens, and that is to, one, always do the right thing, and two, always advise people like the business was our own. We're always available for questions if you have any. We, again, really appreciate your time today, and hope you have a successful 2022.